corporate tax calculations involve more than identifying taxable income and allowable expenditure. Tax legislation often includes a variety of reliefs designed to encourage investment, support economic growth, prevent double taxation, and promote specific policy objectives. In addition, special rules frequently apply when businesses dispose of assets, as gains arising from asset sales may be taxed differently from ordinary trading income. Understanding the treatment of tax reliefs and the taxation of asset disposals is essential for preparing accurate corporate tax computations. These adjustments can significantly influence taxable profits, cash flows, investment decisions, and the overall tax burden of an organization. Tax reliefs are deductions, exemptions, credits, or allowances that reduce a company's tax liability. Governments provide reliefs to encourage activities considered beneficial to the economy, such as investment in new assets, research and development, employee training, environmental initiatives, or expansion into certain regions. Reliefs may reduce taxable income directly or lower the amount of tax payable after the tax calculation has been performed. By reducing the effective cost of business activities, tax reliefs encourage investment and innovation. Management accountants must identify all available reliefs to ensure that corporate tax computations are accurate and that organizations do not pay unnecessary tax. The application of tax reliefs requires careful consideration of legislative requirements. Many reliefs are available only if specific qualifying conditions are met. For example, relief may depend on the type of expenditure incurred, the nature of the business activity, or compliance with reporting requirements. Some reliefs may be claimed immediately, while others may be spread over several accounting periods. Because reliefs vary across jurisdictions and may change over time, tax planning and compliance require continual monitoring of tax regulations. Effective use of available reliefs can improve cash flow, enhance profitability, and support long-term strategic objectives. The sale of business assets can also create tax consequences that differ from those associated with ordinary trading income. When an asset is sold, the proceeds received are compared with the asset's tax value or tax written-down value. Depending on the applicable tax rules, the disposal may generate a taxable gain or a deductible loss. Tax authorities often apply specific rules to asset disposals because gains arising from investments or capital assets may have different economic characteristics from profits generated through normal trading operations. Consequently, separate calculations are frequently required when determining the tax effects of asset sales. In systems that provide capital allowances, the disposal of an asset may lead to balancing adjustments. If sale proceeds exceed the asset's remaining tax value, a balancing charge may arise, increasing taxable profits. Conversely, if proceeds are lower than the remaining tax value, a balancing allowance may be available, reducing taxable profits. These adjustments ensure that the total tax relief granted over the asset's life reflects the actual economic cost incurred by the business. The taxation of asset disposals therefore interacts closely with the capital allowance system and forms an important part of corporate tax computation. In summary, tax reliefs and the taxation of asset disposals are important elements of corporate tax calculations. Reliefs reduce taxable income or tax liabilities and are often used by governments to encourage desirable economic activities. Proper identification and application of reliefs can significantly reduce an organization's tax burden. The sale of assets may also create taxable gains, deductible losses, balancing charges, or balancing allowances depending on the relevant tax rules. Understanding these treatments enables management accountants to prepare accurate tax computations, ensure compliance with legislation, support effective tax planning, and contribute to sound financial decision-making within the organization.